So great to be back, okay, and thanks for waiting. So for today, I'll be covering introduction to derivatives. Okay, so just before I start, right, a few housekeeping matters. Okay, so this information contained in the material is intended for general advice only, and it does not take into account your investment objectives, financial situation, or particular needs. FP Market has made every effort to ensure the accuracy of the information as at the date of publication, and FP Market does not give any warranty or representation as to the accuracy, reliability, as well as completeness of the information contained in this material. Examples included in this material are also for illustrative purposes only. So to the extent permitted by the law, FP Market and its employees shall not be liable for any loss or damage arising in any way, right, including by way of negligence from or in connection with any information provided in or omitted from this material. Features of the FP Market products, including applicable fees and charges, are outlined in the product disclosure statements available from FP Market's website and should be considered before deciding to deal in those products. Derivatives can be risky, right? So this is the topic that we'll be covering for today, and losses can also exceed your initial payment. FP Market recommends that you seek independent advice. Okay, so this is just the disclaimer. Okay, so I'm gonna begin, and along the way, if you guys have any questions, please put them under the questions tab. I'll try my best to answer you guys. Okay. Okay, so I'll be covering, this is basically the agenda that we'll be having for today, right? So I'll be covering on the definition of derivatives in investment, as well as the different type of derivatives that we have. And finally, we'll end off with the pros as well as the cons of derivative products. Okay, so what is derivatives, right? So we hear people in the finance industry talk about it all the time. Okay, so essentially, derivative is a contract that's between two parties. Okay, so their value, right, is based on the agreed upon underlying asset, index, or security. Okay, so this is basically what a derivative is, right? It's a contract between two parties, right, who have agreed upon underlying financial asset. For example, like an index, okay, and the common underlying instruments would be things like bonds, commodities, currencies, interest rates, or even the market indexes. For example, your SPX, US 30, as well as the stocks. Okay, so let's try to understand a little bit more about derivatives in general and what they are. Okay, so they are secondary securities, right, whose value is solely based on the derived value of the primary security. Okay, so the value that they have for these derivative products, essentially, they are linked to the underlying asset. So derivatives, if you want to put it in layman terms, right, they can also be considered advanced investing. So we have two classes of derivative products. So they are called the lock as well as the options. Okay, so we have them classified into two categories basically. So for the lock products, we have things like our swaps, our futures, and even forwards. So essentially for these lock products, they bind the respective parties, from the outset to the agreed upon terms over the life of the contract. Our option products, on the other hand, right? So for example, like our stock options, okay, it can be call or put options. So option products, on the other hand, they will offer the holder the right, but the obligation to buy or sell the underlying asset or the security at a specific price. So this is what we term the strike price. Okay, so essentially, right, when we own these options, so assuming that we buy a call option, let's say on Tesla, it means that if you buy a call option on Tesla at say $600, it means that it gives you the right, but not the obligation, right, to buy Tesla should the price goes above this. Okay, so assuming that Tesla is now at $800 and you have an option, a call option, you own a call option, right? So essentially you would have the right to buy Tesla at a lower price. Okay, so the derivative value is based on an asset, right? And ownership of the derivative does not mean that you own the asset. Okay, so we have other derivatives, for example, like our futures contracts, forward contracts, right? Options, swaps, as well as warrants. Okay, so these are examples of derivatives. Okay, so the first one that we want to go into is the futures contracts. Okay, so futures contracts, it's a type of derivative. And the reason why this is a derivative is because the value of the futures contract is essentially affected by the performance of the underlying asset, right? So a futures contract, right, we might, the definition of a futures contract essentially is the contract for us to buy or sell a commodity or a security at a predetermined price. Okay, and also futures contract have what we call the expiration date. So this contract will have a preset date in the future as well. Okay, so we have a predetermined price in the futures contract as well as a preset date. So futures contract are standardized by specific quantity sizes as well as expiration date, like what we covered. And they can also be used, it can be used in different areas, for example, in commodities such as oil, wheat, or even in precious metals, for example, like gold and silver. Okay, so most of these derivatives, they are traded on exchanges. Okay, so for example, commodity futures, right? They are traded on a futures exchange. So what is a futures exchange, right? A futures exchange, essentially, this is a marketplace in which various commodities, they are bought and sold. So this is where the transactions takes place. Brokers and commercial traders as well, right? They are members of this exchange and they have to be registered, right, with NFA. Okay, so NFA is actually short for National Futures Association, as well as the CFTC. Okay, so CFTC, it's another regulatory body, right? So this is the Commodity Futures Trading Commission. So essentially, CFTC, what they do is that they will regulate the futures market. And this is a federal agency that is charged with regulating the markets. Okay, so essentially, this is to ensure that the market can function in a fair manner. So oversight of this, right, allows us to prevent things like fraud as well as abusive trading practices, and also regulate brokerage firms. Okay, so this, what we covered is the futures contracts. So now we are going to go on to forward contracts. Okay, so forward contracts and futures contracts, right, to some extent, they are similar. Okay, so later on, we'll also be going through the differences between these two products. Okay, so unlike the standard futures contract that we have, right, forward contract can be customized. Okay, so futures contract, we cannot customize this, but we can customize a forward contract. So they can be customized, right, to a commodity amount, right, as well as the delivery date. So commodity traded can be, for example, like our grains, precious metals, natural gas, oil, or even poultry. Okay, so a forward contract settlement can occur on a cash or a delivery basis. So the main difference, right, between a forward contract and a futures contract, like what we covered, so both of them, they take into account future prices, okay? But for forward contracts, they do not trade on a centralized exchange. Okay, so that's the main difference. So they are regarded as what we call over-the-counter instruments, okay? So, or what we always termed it as the OTC, okay? So over-the-counter trades, right? So this OTC nature makes it easier to customize the terms, and the lack of a centralized clearinghouse also give rise to a higher degree of default risk. Okay, so for futures contract, we have it through an exchange. So this is regulated. So because of this, right, it is relatively safer as compared to futures contract, where these transactions usually are take place over the counter, basically. Okay, so because of this, it gives rise to higher default risk. Okay, so just now we covered both the futures and forward contract, right? So right now we want to touch a little bit more on the main difference between these two contracts. Okay, so the main difference between these two contracts, right, is that, right, like what we mentioned just now, both the forward and futures contract, right? So first we go on to this, go to the similarities first, right? So both the forward and futures contract, they involve the agreement to buy and sell this commodity at a set price in the future. Okay, but there is a main difference between these two products, right? So for a future contract, they do not trade on exchanges. Okay, so rather, for a forward contract, they do not trade on the exchanges. Whereas for futures contract, right, these transactions take place through an exchange. Settlement for the forward contract, right, in terms of the difference is that settlement for the forward contract also takes place at the end of the contract, whereas for the futures contract, it takes place on a daily basis. Okay, so that's another difference that we have over here. And more importantly, future contracts exist as standardized contracts. Okay, so we're not able to customize these contracts, whereas for your forward contracts, we can customize these contracts. Okay, so that is the main difference between futures and forward contract. Right, to some extent, they are similar in the way that people are basically people buying and selling at a set price as well as a set date, but the things like, for example, the settlements as well as customization, right, you will be able to do that in a forward contract, but not so much for futures. Okay, and also futures, well, we like we mentioned, they are transacted through OTC. Okay, whereas for forward contracts, we usually do them through an exchange. Okay, so now that we have covered most of it, right, in terms of the difference between forward and futures, as well as what they are, the next thing that we want to cover is equity options. Okay, so equity options is also similar to what we call stock options. Okay, so in some ways, right, they are the same. Okay, so just a quick question here, right? Do you guys trade options? Any of you guys here trade options? Or do you guys trade stocks? Okay, so right now the market has been pretty wild, right? You can see that the SPX and even most of the US stock market, right, in general, they're pushing to new highs. Okay, so stocks. So Vinov trades stocks. Yes, okay. Yeah, so personally, I trade stocks as well. Okay, so you can see that recently has been pretty risk on in the market. Okay, so whereas the risk assets, basically, they're pushing higher, the stock market is pushing higher as well. Okay, so in some way, right, stock options, it's the same. So it mirrors the value, right, of the underlying asset, which is the stock. Okay, so stock option, again, is considered a derivative, mainly because the value, right, that is derived from that of the underlying stock. So assuming that the price of the underlying stock increases, for example, call options for that particular stock then becomes more expensive. Okay, so we have two types of options, right? We have the call option as well as the put option. Okay, so what exactly is a call option and a put option? So for call options, right, basically, it gives the holder the right to buy the underlying stock at a preset price. So this preset price, right, it's what we call the strike price. Okay, and call options also have something that comes along with it, and it's called the expiration date. So when we trade options, right, we have two things we need to take into account, right? The preset price, which is our strike price, as well as the predetermined date. Okay, so which is also what we termed it as the expiration date. Okay, so a put option, on the other hand, right? So put has the idea of sell. Okay, so put option essentially gives the holder the right to sell the stock at a preset price and the date outlined in the contract. Okay, so this is the main difference between a put and call option. So call option essentially gives you the right but not the obligation to buy a stock at a certain price. Whereas for your put option, you have the right but not the obligation to sell the stock at a certain price. Okay, so there is also an upfront cost that is involved, right, in trading options. So this is what we call the option premium. Okay, so when we talk about options, right, in general, we have the risk to reward equation often in display. Okay, so this is the basis for investment philosophy. It doesn't have to be options. It can be anything, even currency trading as well, right? So essentially, risk to reward, the concept behind risk to reward ratio, right, is just that we want to make sure that whatever amount that we risk, right, the amount that we risk in terms of how much we can potentially lose shouldn't exceed the amount that we could potentially gain. Okay, so generally when we talk about risk to reward, right, even though the term is risk to reward, but actually when we talk about risk to reward, like for example 3:1, right, it means that for every 1 unit that I risk, right, my potential gain it's 3 units. Okay, so generally we try not to get a risk to reward ratio of less than 1. Okay, because this is bad, because it just means that the amount that we risk, right, is going to be much bigger than our potential gains. Okay, so generally we want our risk to reward ratio to be at least 1, or if you have certain rules in place, for example, you want to take a trade with a minimum risk to reward ratio of 2, that's possible as well. Okay, so when you have a higher risk to reward ratio, your winning rate can be lower, but you can still be profitable. Okay, so this is the idea of risk to reward. So it is the basis for investment philosophy, and derivatives can also be used to mitigate this risk. Okay, so one way that people usually use derivatives, right, could be example in hedging. Okay, so they can also be used in speculations as well, right, where the level of risk versus reward would be considered. Okay, so for example, right, one example we have is that a trader may attempt to profit from an anticipated drop in terms of the index price. Okay, so for example, we are bearish on SPX, right, or bearish on Dow Jones. Okay, so by doing this, right, we're essentially saying that we're going to sell these indexes. Okay, so we can, one way to go around it, right, is to execute this, right, is to sell this related futures contract. Okay, so derivatives used as a hedge, right, allows the risk to be associated with the underlying asset prices to be transferred. Okay, so this is usually transferred between the parties that are involved in the contract. Okay, so a little bit more on options contract, right? So options contract in general, they are also traded on CBOE. Okay, so CBOE is actually short for Chicago Board Options Exchange. Okay, so this is the largest exchange. Okay, so the world's largest options market exchange actually. Okay, so members of these exchanges are regulated by the SEC, which monitors the market to ensure that they are functioning properly and fairly. Okay, so this is to prevent fraud, right, and just to ensure that the regulation is proper. Okay, so this is on options, right? So for those of you guys who trade stocks, right, this is something that you can consider as well, especially if we want to sell, right? If you want to short or you're bearish on certain stocks, right, you can consider either getting, right, buying a put option, right, which gives you the right to sell at a certain price, or you can consider writing a call option. Okay, so when we are the writer of an option, right, it means that someone else is buying it from us. So if you write a call option, right, the person who bought it from you would be able to buy the stock at a fixed price. Okay, so this is something for us to consider. Okay, so the next one that we have is swaps. Okay, so swap is another derivative product that we have over here. So essentially what a swap is, right? So swap is a derivative contract, and this is through two parties exchange. Usually it's a cash flow or liabilities of two different financial instruments. So most swaps involve cash flow, right? And this is based on the notional principal amount, for example, like our loan or even bonds. Okay, so this instrument, of course, this is just an example, right? It can be anything that we have. And usually the principal does not change hands. Okay, so each cash flow that we have, right, comprises of one leg of the swap. So one cash flow is generally fixed while the other is a variable. So usually what they do with this is that it's benchmarked on an interest rate, okay, or for example, a floating currency exchange rate or even an index price. Okay, so this is an example of a swap, right? So the most common swap that we have, right? Can you guys make a guess? What is the most common type of swap that we hear, right, or that we have? Okay, so anyone knows what it's the most common swap that we have. Okay, so generally, I don't think most people trade this. Okay, so for retail traders, generally, I would say currency market as well as options and even in the stock market. Okay, so the most common kind of swap that we have, right, is actually what we call the interest rate swap. Okay, so swaps. Okay, so I have a question by Paulo. Will you be talking about CFDs as well? Yes. Okay, so I'll be covering CFDs as well. So if you're trading on currencies, for example, then that would be more relevant. Okay. Okay, so yeah, so the most common kind of swap that we have, right, is the interest rate swap. Okay, so like what I covered just now, right, so swap do not trade on exchanges, and the retail investors do not generally engage in swaps. Okay, so swaps are over the counter, right, or what we call the OTC contracts, and are primarily between businesses or financial institutions that are customized to the needs of both parties. Okay, so this is we wouldn't be able to trade this because they're not available on exchanges, okay, and also not available to us in general. Okay, but this is just something for us to know, right, in terms of the different types of derivative products that we have. Okay. Okay, and then we have warrants, right? So warrant is another derivative, right? So essentially a warrant would give investors the right, but not the obligation to buy or sell a security. Okay, so it's most commonly an equity, right? It's probably tagged to an equity at a certain price before expiration. And the price at which the underlying security can be bought or sold is what we call the strike price. Okay, so to some extent, right, some of the terms used, it's very similar to options. So an American warrant, right, can be exercised at any time on or before the expiration date. So we have two types of warrant here, right, the American one as well as the European warrant. Okay, so can you guys make a guess, right? What is the main difference when we talk about American as well as European warrant? Okay, so what's the main difference between both of them? So any takers, right? So if you talk about American as well as European warrant, right? If you to compare both of them, right? What is the main difference between them? Expiry, I have a yes. So yep, you're right, Ivan. Okay, so the main difference is the expiry in terms of when it can be exercised. Okay, so for American warrant, right, they can be exercised at any time. Okay, whereas for your European warrant, they can only be exercised as at the expiration date. Okay, so that's the main difference, right, when we talk about trading American as well as European warrants. So warrants essentially gives the right to buy a security, right, and they are known as what we call the call warrant. Okay, so essentially it's the same as call and put options, right, and that gives the right to sell as a security are what we call the put warrants. Okay, so you can see in some ways, right, when we go through this, okay, so in some ways when we go through this, warrants and options, to some extent, they are the same, right? So they are similar in many ways, but there are a few key differences, right, to between these warrants as well as options. Okay, so again, does anyone know what is the main difference between warrants and options? Okay, so given that they pretty much function in the same way, if you have a put or buy warrant, right, buy warrant functions in the same way as a call option. Okay, okay, I have a question by Ta, right? So why can't I access the FP Markets website? Okay, let me hop onto that later. Okay, so after the slides, right? So that's strange because it should work. Okay, so let me just hop onto that later on, right? So FP Market website is down. Is anyone else experiencing this issue? Right, where you guys can't access the FP Market website? Okay, so let me just try it later on, okay? Okay, so back to the question, working for me. Okay, so it's working for Paulo. Okay, so Tai, you might want to try again, right? It seems to be working fine. Okay, so back to my question, right? So what is the main difference between options and warrants, right? Given that they pretty much function in the same way, can you guys make a guess, right? What is the difference? So anyone can make a guess? What is the main difference between warrants as well as options? No? Okay, issuer, yes. Okay, so yeah, Evan, you got it. Okay, so yes, issuer is the main difference between warrants and options. Okay, so warrants, they are generally issued by the company itself, okay, not by a third party, okay, and they are over the counter transactions. Okay, yes, okay, awesome, Ivan. Okay, so yes, they are over the counter transactions, whereas for options, right, they are usually through exchanges. Okay, also we can write options, right? We can write call put options, but for warrants, investors cannot write these warrant. Okay, so unlike options, right, the issuer is different in terms of how warrants, they're usually issued only by the company itself, whereas for options, right, we can be the ones writing call put options. Okay, so this is the main difference between options and warrants, right? To some extent, we can see that they function in a similar way. Okay. Okay, so next we have CFDs, right? So this is what you guys, I think, will be slightly more relevant if you trade, for example, currency, right, and the FX market. Okay, so the type of another type of derivatives that we have, right, is contract for difference, right? So it's also commonly termed as CFDs. Okay, so CFDs, essentially, this is a contract between the buyer and the seller. So this stipulates that the buyer must pay the seller, okay, the difference between the current value of the asset and its value at contract time. Okay, so essentially how this works is that if we have a CFD, right, so for example, let's say we buy a contract, right, for let's say $9, okay, so maybe the price of a stock, right? So in this case, what happens is that we don't own the value of the stock, but when we buy the stock and the value of the stock goes up to $10, we earn the difference, which is $1. Okay, so depending on what's the volume that you got in it, right, we will be profiting from the difference between price movements. Okay, so that's essentially how a CFD works. Okay, so CFD would allow the traders as well as investors an opportunity to profit from price movement, right, given the example that we have just now, without owning the underlying asset. Okay, so the value of a CFD contract also does not consider the asset's underlying value, right? Rather, what they do is that they will they will consider only the price change. So for example, between the entry price as well as the exit price. So using the same example that we have just now, right? So assuming that we bought the price the CFD, right? So assuming that it's at $9 and right now it falls to $8. So what happens is that for each contract, right, we actually lose $1. Okay, so essentially for CFDs, they only consider the difference between the entry and exit price. So CFDs, right, they're accomplished through a contract between a client and a broker. So usually they don't utilize any stock, forex, commodity, or futures exchange. Okay, so we can trade on the broker, right? So for example, if you have the FP markets MT4 loaded, okay, so that's when we can actually take trades from that, right? You can see most of the time, right, it would be in the FX market, right, even though we do have offers for stocks as well. Okay, so trading CFDs offer several major advantages, right? For example, you have increased the instrument's enormous popularity in the past decade. Okay, and also there is a much smaller capital involved, right, in terms of the upfront capital. Okay, so we have already covered just now, right? So the main thing about CFD is essentially a contract that is between investors as well as the broker, And what investors do is that they will either profit or make a loss, right, from the difference in terms of the entry and exit price. Okay, so essentially, right, investors can use CFDs. Okay, so this part is more relevant to what we are doing, right? So if you guys are trading, right, what you can do is that you can use CFDs to make bets, right, about, or rather not bets, but basically have a view, right, of whether price of the underlying asset or security will rise or fall. So in having that predetermined view of the asset, right, or the price of a certain product, for example, like it can be euro dollar or even Apple stocks. In this example, what happens is that this can be derived from either through TA or FA. Okay, so TA is technical analysis, where basically we look at price actions, we look at charts, as well as indicators to try to find a good entry or exit. Okay, so the other side of it is, of course, fundamentals. Okay, so fundamental analysis. This is usually slightly more applicable for stocks. Okay, so for example, we measure, let's say, the PE ratio, the PB, price to earnings ratio, the price over book ratio, things like that, to determine whether the stock is under or overvalued. Okay, so these are the two main components, right? We can carry out the analysis. In the forex market, for example, right, we will look at things like the bigger, the macro landscape, right, or the bigger picture, as well as interest rates and key economic events. Okay, so economic data. So for this, right, we have to follow the economic calendar very closely. And other examples of fundamentals include, for example, like the market risk sentiment, right, whether it's a risk on or risk off market sentiment. Okay, so essentially, right, investors can use CFD, right, to make a bet about this, okay, as to whether the underlying asset or security will rise or fall. Okay, so we can have bets, right, whether it is going up or down, right? So if it's going up, then we expect prices to push higher, and then we'll take on a long position. Okay, if it's going down, for example, right, then we will take on short positions, right, and expect and when we expect prices to push lower, right, that's when we want to sell, hoping to benefit from the difference. Okay, so essentially, when you expect prices to drop, right, we are selling higher and buying back at a lower price. Okay, so that is the one way that CFDs can help. Okay, so an example, right, so let's say we purchase a CFD, right, so when, okay, so if we purchase a CFD and we see that the asset of the price increase, right, what happens is that it then translates into profits for us. Okay, so the net difference between the purchase price as well as the sale price, right, they are then netted together, right, and then that will represent the gain or the loss that we have from the trade. Okay, so I have a question by Paulo. If you hold a position overnight, what fees would you incur? Okay, so the fees differ, right, accordingly. So for the fees, right, in terms of the instrument, right, we have to refer to the market, FP Market website. Okay, so let me hop onto that later on, okay, and I'll try to find. But this is a very big question because it depends on different things that we have, okay. And apart from that, there's also the commissions for every round turn. So when you execute a trade, right, when you buy and sell, or when you buy and sell and close the position, right, there will be fees incurred as well. Okay, so let me try and find out on that one. Okay, Paulo. Okay, so I'm going to hop onto the website later. Okay. Okay, so back to the slides, right? So just now I talked about buying a security, or rather buying a CFD, right? If we believe that prices are going to push higher. On the other hand, right, if we believe that the value of the asset would decline, what we want to do is that we'll place a sell position. Okay, so we'll basically sell the asset or short the asset, right? You hold a short position and you expect prices to push lower, and from there we would profit from it. Okay. Okay, so are you guys familiar with the different terms that we use, right, in terms of long, like for example, if you want to buy and sell, right, buy and sell, it's okay. Another term that people use for buy and sell, right, it can be long and short. So if you're holding a long position, it means that you are expecting the price to push higher. Whereas if you are holding a short position, you're expecting prices to push lower. Okay, so that's one example. And also, for example, right, another term that we have, right, that's common, it's bullish and bearish. So if you're bullish, right, it means that you're expecting the market to push higher. So if I say that I'm bullish on a stock, for example, it means that I'm expecting prices to climb higher. Okay, so conversely, if I'm bearish on a stock, right, it means that I'm expecting prices to push lower. So if that is the case, right, I want to consider opening a short position, right? Or I want to consider owning, for example, put options. Okay, so that's just a brief overview, right, of the terms. Okay. Okay, so I have another question by Bevan, right? Does CFD trading need a different account than an FX account? No, you don't need a different account. Okay, it's on the same account. Okay, so in response to your question, Bevan. Okay, so yeah, so for CFD trading, right, you can actually open the FP Markets account, right, and have it on either the MT4 or MT5. Okay, so and from there you can actually execute the trades, right? So you have the long positions, buy, sell, things like that. Okay. Okay, so the other one that we actually want to cover, right, is on OTC transactions. So just now I briefly covered up on OTC, right? So for OTC transactions, right, these trades essentially, right, they are done over the counter, right, as the name suggests, OTC. So it is important to note that the regulations can vary. Okay, so it depends on the product as well as the exchanges. So in the currency market, for example, right, the trades are done via over the counter. Okay, so it's usually between brokers and banks versus a formal exchange. Okay, so two parties, for example, corporation and a bank, they might agree to exchange a currency for a specific rate in the future. Okay, so banks and brokers in general, they are regulated by the SEC, but the investors need to be aware of the risks with the OTC markets since the transactions do not have a central marketplace. Okay, so this is slightly more risky, right? Mainly because there is no centralized exchange. Okay, and also at the same time, we don't really have that kind of regulatory oversight, right, that we have in terms of the normal exchanges or the normal transactions, right, that we do over the centralized exchange. Okay, so when we talk about OTCs, right, in general, this is what we mean. Okay, so basically, these transactions are not carried out with regulatory oversight. Okay. Okay, so I have another question by Vinov, right? So does each CFD have a fixed amount, a fixed number of units? Can I have control over how much exposure I have? Yes, Vinov, you can. Okay, so they do. So depends, again, it depends on the instrument that you trade, right? So I can't say for sure, right? If it's stocks, it's probably one. But if it's you are talking about FX, right? It depends on the account. So generally for FX account, right, the smallest lot that we have is 0.01. Okay, so yes, you can control the exposure that you have. Okay, so unlike, for example, futures contract, right, when you buy a wine contract, right, usually it represents a fixed unit, but not for CFDs. Okay, so you can have a fixed number of units. They are small. Okay, so if we have a modest amount of capital, right, this can be useful. Okay, so yes, you can control the exposure that you have. Okay, so yeah. Okay, so yeah, so that's what we have, right? Okay, you're welcome, Vinod. Okay. Okay, so let's see. So now let's go on to the advantages. Okay, so just now it's on our agenda as well, right? So the main advantage of derivatives. Okay, so we have a few advantage, right? The first one is hedging in terms of the risk exposure. Okay, so they're often used in hedging. So the idea of hedging is just for people to take basically change, or rather take the opposite side, right, of the positions that they already hold. right, to limit the risk. Okay, so the value of the derivative itself, right, it's linked to the value of the underlying asset. So these contracts are primarily used for hedging risk. Yes, okay. Yep, so exactly like what you said. Okay, so Ivan put it in a perfect way. Okay, so I couldn't have it better. Essentially, he said that it's like insurance. Okay, so yeah, essentially that's what it is, right? Hedging is like insurance. Okay, so these contracts, right, they are primarily used for hedging risk. So for example, the investor may purchase a derivative contract, right, whose value moves in the opposite direction to the value of the asset that the investor owns. Okay, so yes, okay, so that's what we have. So let's say, right, in some ways, for example, if we bought into Apple stocks, right, at a certain price and we're bullish on it, but you can actually buy put options. Okay, so assuming that, let's say, Apple stocks is at $100 right now. Okay, so if it's at $100 right now and you're expecting price, you bought in at $100 and right now prices are at, let's say, $120, right? Essentially, we have a profit of $20. Okay, so one way we can hedge this risk, right, or protect our position is by buying a put option, right? So remember what we covered just now. Put option essentially gives us the right but not the obligation to sell the stock at a certain price. So assuming that you buy a put option, let's say at $110, right? So this means that we would seal this profit, right? Because we're buying at $100. So if prices did reach $110, for example, or even if it falls below $110, we would be able to sell this stocks at $110. Okay, so in some ways, right, we actually hedge this risk, okay, and protect our profits. Okay, yes, okay. So another way, right, like what Ivan mentioned, is selling call options. Okay, so when you sell call options, right, essentially what you're doing is that the buyer of the call options would have to buy the stocks from you. Okay, so yes, so when you sell call options, right, you're essentially selling the stocks. Okay, so yes, with a higher strike price. So that's another way to do it as well. So you can either buy a put option or you can sell a call option. Okay, so yep, so you got it, Ivan. Perfect. Okay, so that's what we have in terms of the risk, right? So that's one way people actually use derivatives to hedge the risk, right? Like the example that I gave just now. And another advantage is that it pretty much determines the underlying asset price. Okay, so the price determination of these options or even these derivative products in general, right? They are derived from the underlying asset price. Okay, so for example, the spot prices of the futures can serve as an approximation for a commodity price. Okay, so the third advantage that we have in terms of derivatives is that they are very efficient. Okay, so derivatives increase the efficiency of the financial market, right? The reason behind this is because when we actually use a derivative contract, right, we can replicate the payoff of the asset. Okay, so prices of the underlying asset as well as the associated derivative tends to be in equilibrium. Okay, so this is important because if it is not in equilibrium, right, what happens is that people tend to capitalize on these opportunities, right, what we call the arbitrage opportunities. Okay, so when this happens, right, then the market, when people capitalize on this, right, the market then corrects itself. Okay, so in some ways, right, derivative products help in making the market more efficient. Okay, so these are the advantages, right, that we have for derivative products. Okay, and then of course we have disadvantages as well, right? So there's always two sides to coin. Okay, so the disadvantages of this is that, right, despite all the benefits that we have covered, right, derivatives also come with significant drawbacks. So one example would be, right, the disastrous consequence that we witnessed in the GFC, sorry. Okay, so the global financial crisis in 2007 and 2008. So essentially, right, over leveraging, right, as well as this basically rapid devaluation of the mortgage-backed securities. Okay, and this credit default swaps also led to the collapse of the financial institutions. Okay, so for example, Lehman Brothers, right? That's one of the banks, right, that collapsed, right, as a result of this, and securities around the world, basically. Okay, so this is one example of how derivatives can also pose as a risk. But of course, with all products, right, as long as the risk is managed properly, right, it shouldn't be a problem. Okay, so well, the first one that we have, right, is the high risk that's involved, right? So the huge volatility that we have for derivatives, right, exposes them to huge potential losses. So you're right, Ivan. Okay, so leverage is also a plus and a minus. Okay, so there's always two sides. It's like a double-edged sword. It can help us, right, because the upfront capital is much lower and you can have a much bigger position, right, depending on the leverage. So assuming a leverage account is a 1:100, right, for every $100 you can open $10,000 worth of position. Okay, so yes, but at the same time, right, because of this leverage, it can also wipe out the account very quickly. Okay, so it all boils down again to risk management, right, which we will be covering in future webinars. Okay, so risk management as well as risk to reward ratios, right, those will help in our trading. Okay, so yes, yeah, leverage is a plus as well as a minus. Okay, so for the high risk, right, so the high volatility is in terms of the derivatives involved. Okay, so apart from the leverage as well, derivatives in general, they're also very volatile, and because of this, right, we could have huge potential losses. Okay, so of course there's a flip side of the coin, right? This is a disadvantage, but it can also be an advantage as well, right? So with huge losses, right, there might be huge gains too. Okay, so this design of the contracts make valuation extremely complicated or even impossible. So inherently they bear a risk, okay, a high risk. Okay, derivatives, okay, because we do have futures and forwards, for example, right? They are also highly speculative. Okay, so they can be seen as a tool of speculation. So due to this risky nature of this derivatives, right, as well as the unpredictable behaviors that they have, this can in turn lead to huge losses. Okay, so again, like I would like to mention again, there's flip side to the coin, right? So it can lead to huge losses, at the same time also potential gains. Okay. And lastly, and most importantly, right, there's also counterparty risk. Okay, so these derivatives generally they trade on exchanges. Okay, so they generally go through a thorough due diligence process, right? And many of the contracts traded over the counter, for example, they don't have a benchmark for this due diligence. So we pretty much briefly covered what OTC is, right? Essentially, these transactions take place over the counter. We don't have an exchange, right, to regulate these transactions. So because of this, there can be higher default risks. Okay, so there is possibility of a counterparty default, okay, in some cases. Okay, so those are the main three disadvantages that we have for derivatives. Okay, so with that, we have come to the end of our webinar, right, on introduction to derivatives, right? So the main products that we have here. Okay, so do you guys have any questions? And just so if you guys have any questions, right, you're very welcome, Paulo. Okay, it's a pleasure to be here. Okay, so just before I end, right, let me just log into the FP Market website and show you guys. Okay, so let me just hop onto this. So you can actually find our webinar schedule, right, on the FP Market website. You're very welcome, Bevan. Okay, so I'm glad that you guys enjoyed this. Okay, so let me just bring this up and show you guys. So FP Market, right, you can actually find this webinar schedule here. Okay, so it's here. So this is actually a list of what we will be covering. Okay, let's see. Okay, so under resources, webinars. Okay, so you can see here, introduction to derivatives, right? So for today, this is what we are covering. And then we have technical analysis as well. Okay, so just now I briefly mentioned that we have two types of analysis that we cover, right? Mainly technical and fundamental analysis. So for technical analysis, we're talking about looking at charts, reading patterns, charts, price actions, as well as indicators. Okay, so you can see this will be on 25th February. Excuse me. We also have a fundamental analysis, right? So for fundamental analysis, we'll be looking at things like the general macroeconomic landscape, interest rates, right, from central banks, for example, like your Fed, your RBA, things like that, right, and how it affects currencies, as well as the economic event, okay, the calendar, right, economic data, for example, CPI, GDP, and how it's going to impact the currency movement. So this is on fundamental analysis, right? So you're looking at basically a bigger picture. So how we can combine this is that for technical analysis, right, or rather on fundamental analysis, you have the bigger picture. For example, like we think that dollar is going to weaken further, right? So we want to consider if it's in a more risk-on environment, right? We want to consider maybe shorting the dollar and longing riskier currencies, for example, like Aussie, Kiwi, things like that. Okay, so we'll be covering on the market risk sentiment as well as the different currencies and how they're classified and what are the factors that affect them. Okay, and then support resistance basics. So you can see that this is the schedule that we have pretty much for February and March. Okay, so it'll be pretty much in the same structure as what we have for today. Okay, and then if you guys have any questions along the way, right, we'll do our best to answer them as well. Okay, so yep, so this is what we have. Okay, so yep, so like what Ivan mentioned, right, ignorance is the greatest risk. So yes, we don't know what we don't know. Okay, so it's apart from ignorance, also risk management. Okay, so it's important to know what we are exposed to as well, so that we are able to better manage our risks. Okay, nice presentation. Thanks. You're very welcome, Ivan. Okay, so thanks for being so responsive as well. Okay, so if you guys have no other question, right, this is all the time that we have for today. Okay, so thanks everyone for joining this presentation, and we will catch you guys in the next webinar. Thank you and goodbye.